China ends 2020 with record trade surplus. We'll see right here what happens this year, but at least that's what they're claiming. Exports, imports grew faster than expected in December. Demand for medical supplies and electronic goods surged last year. I know specifically that trying to get the goods out doesn't seem to really be an issue in terms of, problems in the supply chain, but ultimately what we're looking at is that there is demand coming out of there. Prices, statistically, I have seen them rise. The actual cost of shipping via sea seems to have risen, but it is generally a very low cost thing when you're doing that shipping compared to air freight. So, while they say that the cost has increased, generally it doesn't mean that much in terms of the demand that's actually being put onto those who have to purchase, who have to do the imports and the exports and so on. So that's just something I noted anyway. China export boom continued in December, pushing the trade surplus to a record high in the month and bolstering what is already the world's best performing major economy. So they say at the bottom there, you could see the chart that corresponds. And all I'm trying to show you is that I've showed you in the previous couple of videos that there is a serious issue between the US and China today. Although it was supposed to be the exact opposite, it looks like it's going in this direction. They had been purchasing apparently lots and lots of agriculture. They did not hit any of their targets. None of the targets were hit as far as I'm aware. I'll give you some information on that, but they did purchase quite a bit. And, still you're seeing all of this right now, and it just shows you what has happened throughout 2020, and there has been some very big changes in the economic growth of China as well as the US, and we'll see what happens because the numbers are very let's just say not exactly accurate. So we have to go by what we have. And we also use the anecdotal evidence. We also have to look at, the delays that are being experienced and talking with the actual suppliers and trying to get word from them and so on to get some insight that's not really statistics that are coming from the government and so on. So with all of that, stay tuned. I'll bring you more info. In hilarious news, Powell sees no interest rate hikes on the horizon as long as inflation stays low. Quote, when the time comes to raise interest rates, we'll certainly do that. And that time, by the way, is no time soon. As you saw other members of the Federal Reserve saying, there's going to be a time in which we start to taper. The market urinated and ruined a pair of underpants. So as a result, Powell had to come in and do the underpants bailout. And I know that's kind of silly, but that's really the way it works today because the market is unable to deal with any sort of rate hike whatsoever. If they even talk about pulling it off the floor, 0.25 maximum, they're going to bring it up just a quarter. A quarter? No way. You can't bring it up a quarter, 25 basis points. We're not going to do that. Don't even think about it. We're not even thinking about. That's what he said. This is a joke, and they are unbelievable in what they do. And here we are time and time again. One of the members of the Fed says just a little something, and they have to come in and rush to this being the savior. It's a joke. Jerome Powell sought to stamp out the talk of premature reduction in the central bank's massive bond buying program that's saying apparently now is not the time. We need to, right here, we know we need to be very careful in communicating about asset purchases. He's basically telling his friends at the Fed, don't say that kind of stuff ever again, okay? Now is not the time to be talking about an exit. I think that is another lesson of the global financial crisis, to be careful not to exit too early. And this is right here, a spit in your face. Because they spent so many years. In fact, I have an entire article, I guess it was a report that was done by the Federal Reserve, the St. Louis Fed specifically, that I want to do an entire video about, because they said we are going to return to normal on the balance sheet, the normalization, and they were very adamant about it. And of course, that never happened. They were talking one way all throughout, let's say 2013, 2014, 2015, and then things really changed as we got into 2018, where they started to be apologetic of doing this. It is an absolute bunch of garbage and baloney. I'm sick of it. I'm sick. I read this stuff constantly and I get absolutely sick to my stomach. Bond market's scariest gauge is worse than ever. Corporate credit markets are more exposed to duration risk than at any other time in history. Now that's some pretty, it's a bold statement. Let's look at it. It is a very detailed explanation that he has here, and essentially what we're looking at is the Sherman Ratio. We'll get into it. I just want to talk about the fact that corporate credit, corporate debt, you're looking at, the BBB rated debt, things that I've talked about before. The Federal Reserve had to come in and start buying the fallen angels, as they call it. ETFs were created around that, specifically on the fallen angels, so that we can create a demand for the absolute garbage. But regardless, you can see that this is one of the weakest points. There's no doubt about it. There's way too much of it, and a lot of it is, quite frankly, not very good. May I say garbage? Well, if that gauge was scary in January 2020, when he originally talked about this, it's downright terrifying now. The Sherman Ratio, named after DoubleLine Capital Deputy Chief Investment Officer Jeffrey Sherman, basically shows that the amount of yield investors earn for each unit of duration. Okay, so then let me repeat that. The amount of yield investors earn for each unit of duration. It tumbled to as little as, check out this number, 0.1968 on December 31st in their index. That's a record low in data going back more than 3 decades. That compares with the previous low of 0.3 that he was talking about in January 2020. And while that former milestone wasn't too much lower than previous instances, current investment grade corporate yields are an outlier in every sense of the word. So this just gives you some insight as to what's happening. This continues to move down. They show you some charts in here. I definitely don't have time to get into it in too much detail, but understand that where it's headed right here is a problem, because the bond market often is more important than what the Federal Reserve says. It's more important than what we're seeing in the stock market. It is a better indicator than so many other things. They often say that the bond market doesn't lie. Of course, it can be manipulated, it can be swayed, it can be pushed up and down, but we have to understand how much is really invested in the bond market, despite that it's losing its attractiveness as we see. It doesn't matter, because the indicator that indicators of the bond market and, every sort of factor, the way I see it, is really telling. And this is just one point that I wanted to really highlight right now. I personally did not expect this, but wanted to touch on it. Manhattan bargain hunters drive a 94% jump in apartment leases. Deal signings surged the most in almost a decade last month. Freebies, falling rents draw tenants, but units still pile up. So there is a problem. It's not as if it's suddenly resolved, but I thought it was interesting that even at this time, people are starting to scoop this up. Hey, maybe I'll get a free month or two. I'll get this happening for myself. We'll see if it goes on in other places, but Manhattan being one of the most hurt places in this regard, is seeing a jump up. We'll have to cover this as it unfolds, but I'm definitely seeing that inventory had climbed significantly year over year. More on this issue of migration, whether it's talking about personal or business, a growing number of tech companies are packing their bags and moving out of the Golden State. So we're seeing a couple typical patterns. I'm looking at California to Arizona, California to Texas, and I'm also seeing a lot of New York, New Jersey moving to Florida. There are others, certainly, but that's generally the way I've been seeing it oftentimes. Leading names in the industry are now added their names to the list. This is a major wake-up call. HP, software company, Oracle, and Elon Musk, founder of Tesla and SpaceX, all three big names in tech, are packing for Texas. It has to do with taxes, clearly, because the states that have been winning recently is the states that don't have any income tax or corporate taxes. Of course, this is what they're doing. This is what we are seeing on so many levels, and more continue to be added to the list. It's not just the US, we're seeing it all over the place. Younger Canadians moving away from big cities at record levels. You could see the trends here, but I just want to highlight the fact that we're looking at this all over the place. Big cities, they're starting to disperse. They are going to the suburbs because no longer is that 1-bedroom or 2-bedroom apartment going to be sufficient. They need more space. They're going to be working at home for the foreseeable future. So they have to move out to find a place that's probably affordable to them. And so they need something bigger. They have to sort of sprawl. We'll see what happens if that starts to reverse the trend and people start going back to the offices. As of right now, that's not happening. Quick note to end the video, Christopher & Bank store closing sales, all locations liquidating after retailer files for bankruptcy protection. They had hundreds and hundreds and hundreds of stores, apparently could be closing all of their stores. We'll see what happens, but it's just one more to add to the list, and that means jobs are going out. The last tally that I saw was only around, and I say only, around 9,000. I don't believe the numbers that I was looking at, considering how many different businesses were shutting down 2020, but it was something like 8,500 and change or whatever it was on CoreSite and their tally. I don't think that's accurate at all, but regardless, that's the numbers we're seeing. It's around the historic high. We know that that's the case. We know it is the highest it's ever been, regardless of what numbers they're putting out. So many jobs are lost, and I'm not sure what's going to happen as a result. If you found the video informative, hit that thumbs up button. If you hated this video, make sure to hit the thumbs down. Okay, I love those thumbs down as well. If you want to learn about e-commerce, you can go online. There's tons of courses out there, charge you about $1,000 for a decent one. There's also some that go $2,000 and above that, or you can learn for free, whichever one you choose, the AmazonGPS.com. If you want to understand the financial system, you want the no BS version of it, my 2 books are exactly that. You can get them at the link in the description. And if you haven't seen this video yet, you definitely want to check it out. Click it. I'll see you there.